Alright, welcome back to accounting. Let's do some today. We're going to learn about credit purchases and cash purchases. Excuse me. Alright, so how does a business purchase equipment? A couple ways. They can use cash or credit. Now, there's a need for it, yes, because the business needs computers and desks and chairs for the clients and pens and pencils and so on and so forth. You don't just walk into somebody's office and they have all their papers scattered all over the floor. Hey, I'd offer you coffee, but we didn't buy any equipment. Now we're going to look at if they purchase it with cash. Where does the money come from? Now, in this example, it's going to come from the capital that we have from the consulting firm that we put capital. Remember, $100,000 we put in, and we're going to look at where that cash is going to go as far as the ledger. Do we need credit for cash purchase? Not for this one, because we're just going to give the guy cash and he's going to give us the equipment. So there's no need for credit. It's paid off. It's debt free. So let's take a practical look at this. The cash balance, as I said, was $100,000, and we put that in last time through the capital. Now he's going to purchase equipment for $5,000. So he's going to buy a desk and a computer and some chairs and whatnot. And he paid cash for him, so there's no need to go into debt. It's a clean purchase. He now has $95,000 in cash and $5,000 in equipment. Now, both of these are still assets. These still equal $100,000. And, a lot of people are going to look over here and say, well, how does he have a capital of $100,000 he spent? Well, remember, this equals $100,000, and these are both assets. This is still money. It's just somewhere else, and it's invested somewhere else. So it's going to still equal $100,000. Remember, debits equal credits, and that is a credit account. We'll go over that later. All right, equipment purchase with credit. Where does the money come from with credit? Well, usually a bank. Now, a person can be a creditor or act as a bank. You go to your friend Bob and you say, hey, Bob, I have a business I want to start. I got to buy a couple desks, and would you loan me like $5,000? Yeah, sure. You can pay $100 back a month and 2% interest. Okay, great. And that person is acting as the creditor. It's not a bank per se. Now, how do we account for credit? This is going to add an account in our ledger because now we have an accounts payable. So let's go over that because I have a little example here. Now remember, we already bought $5,000 of equipment, and we had $95,000 in cash, and that's still equal to the capital of $100,000. Now we're going to purchase equipment on credit. So we have $6,000. We purchased it through a bank loan or by Bob, our friend, but we owe somebody that $6,000. They gave it to us to borrow. And you incurred the debt of $6,000. That goes into your accounts payable. Accounts payable is always going to be for credit, for bills, things like that. You use the water at your house, you have an accounts payable as far as your bill. We go down here to the total after we get done with all this, and we see we still have $95,000 in cash, $11,000 now in equipment, 5 and 6 is 11. We have $106,000 in assets. Remember what I said, assets equal liabilities. So we have $6,000 here in accounts payable, and we have $100,000 in capital. So we still have 106, so it equals out. Now we haven't made a payment here yet, so that's going to just sit, it's a net 30 or net 45, and we'll get into net terms later on. And I threw this one in. I thought this one was pretty cool. Purchasing supplies. Now remember, we purchased $11,000 in equipment, and we have $6,000 sitting on the books. We purchased supplies, $95,000. We added $15,000 in supplies, still asset. We paid cash for it, so we didn't have to use credit this time. And we have a new balance of $93,500 in cash. We have $1,500 in supplies. Remember, this is still an asset. Even though it's not pure cash, it's still an asset. Equipment, we have $11,000, still an asset, and that comes out to $106,000. Now, that equals out here. Accounts payable is still sitting with the $6,000 balance. And remember I said we're going to get into net terms later. And capital is still $100,000 because this is all capital. This doesn't change just because we use cash to pay for something else. It's still capital. It's still an asset. And it equals out to $106,000. So that's going to be the end of this one on purchasing on credit. We're going to go over net terms, and we're also going to go over rent and how you equate for that. So join me in my next lecture. Thanks for listening.